Joining us now with where he is putting his money, Cole Smead, Managing Director and Portfolio Manager for Smead Capital Management. Morning, Cole. We've got kind of a split market here, right? Everyone kind of can acknowledge U.S. consumers in very good shape for all the reasons we know. The industrial economy having some hiccups and a lot of defensive type stocks, growth stocks, quality stocks, so to speak, have been doing well to the exclusion of many others. So where is your stock picking process bringing you within all those factors?
Well, it's not dissimilar to where Buffett's been sitting. Buffett's been the buyer of financial stocks en masse, more so than really anything else he's had in the last 6 to 12 months, with maybe, not talking Apple. There's a huge opportunity. You were just talking about the three bond managers who have been, kind of roughly short the Treasury market or where, thinking yields are going to climb. Michael Hassenstab's in that boat, too. And everyone on that side of the boat has got punished. And financials would obviously benefit from long-term economic growth and higher rates. And that is something that people, or as you mentioned in the quality kind of safety trade, they perceive that that's just not likely in the interim. And the question is, who's going to make the money? The people that are betting for safety and low rates, or people that are betting that the world is going to change at some point?
So what sort of financial stocks? I mean, essentially just looking at the banks, which, as you say, have been punished not just because of where yields are, but just as a general sense of if we're getting toward the end of a cycle, maybe they're not the place to be.
Yeah, I mean, we own Bank of America, Wells, and J.P. Morgan. Wells is obviously the most contentious just because of they need a CEO. They're coming off of all the woes they've had as a bank. Interestingly, we were looking back. We've been an owner of Bank of America since early 2012. And Brian Moynihan might be the most understated CEO we've really ever seen. Jamie Dimon's the noted banker on Wall Street. And Moynihan's this lawyer by background, came from Fleet Financial, and has just done all the right things, produced fabulous returns, and finds himself in a position where he was on your show 6 months ago saying the Fed does not need to lower rates. And here is the insurance cut. And Moynihan thinks the economy is plenty strong. So we're in the Brian Moynihan camp as it pertains to the economy. And the biggest risk is that corporate America is borrowing a ton of money. It's great for Wall Street. As you were talking about the prior segment, as you look at executives looking to a greater good in society, well, they're doing that with the lowest rates, roughly the most confidence they've ever had, and the cheapest money to talk about doing good things in society, when the reality is they're funding most of their buybacks with purely debt. Okay, 56% of buybacks are coming off debt. So I think it's more symptomatic of a late bull market arena, not here's the next great leg up in 5 years more of this game going on. The insurance cut was good for Wall Street and good for keeping stocks at ease, but it doesn't really change what's going to happen in the next 5 years for people waking up to what could be a tough market.
So I agree with you on the financial side, and I think Bank of America, J.P. Morgan are good companies there. One of the fears of kind of everybody looking at this is credit quality and kind of being at the 8th or 9th inning. Our view on that, and I don't know if that's kind of where you look at it, is that's baked in given the valuations. I mean, you're trading at price to book. You're trading at one of the lowest multiples and great balance sheets as well. Yeah.
Well, I just look at the earnings multiple. If you want to find cheap valuations in the S&P 500, if you want to go to the lowest PE quintiles, you'd have to end up in financials. There's no way around it as it pertains to looking at price to earnings ratios as an example. And the oddity to this bull era, if you look from 2007 to today, the oddity is the most expensive PE quintile of the S&P 500 has done the best. That's the opposite if you look back at any other period of market cycles. The cheapest stocks have done roughly the worst. So the irony is the banks find themselves in the cheaper quintiles of the market. They have everything to do with economic growth, rates, exactly what people have been instructed by the market in the last 2 months to not think can ever happen. We're contrarians by nature, but we've owned these for a long time. We think people are going to be punished in the bond market in such a way where retirees are probably going to think, how did that ever happen? When the reality is Buffett's advocating for people to own the stock market via Vanguard, not because he's bullish on stocks, but because he thinks bonds are so terrible over the next 10 years.
So you say, as a firm, contrarian by nature. Where else does that take you at this point? I mean, I know you've owned and spoken about Disney plenty. Does that qualify as a contrarian bet right now? Because the stock has certainly done well.
Yeah, no, and they're in their little spat with Sony over Spider-Man, which has been kind of the talk du jour the last couple days. 2 years ago, ESPN was dead. What's Disney going to do? Netflix is going to win the game, and the world's going to be ending with Netflix and Amazon. And Now you wake up at 35% higher stock prices, and in our opinion, not much has changed in their business, and people are just more excited about a higher stock price, ultimately, is what I would tell you. So that on the margin is not good. It looks like people are just kind of running out of ideas to pitch on the street, ultimately. As it pertains to other places that I think are more compelling, Discovery Communications with HGTV and the Food Network Travel Channel. When they brought in Scripps, that's how we got into that deal from the beginning. And we got John Malone there trading at great valuations with great franchises. And Chip and Joanna will be as big as they've been at Target when they get their channel. We just think that's going to be a big driver. Other places that we're finding about, you're talking about oil. Yep. Oil skipped a 10-year bull market. I mean, you want to talk about depressing. We've been long-term oil bears, and we find ourselves being the biggest buyer of Oxy out there.
All right, Cole, thanks a lot. Ran through a lot.